Happy New Year, everyone. And I wanted to spend the new year reminiscing a little bit about something that happened in 2010 when I first came to SMB to take their intraday equity trading course called Equity Foundation. And Mike Bellafiore teaches a lot of the course personally. And one day he gathered all the traders into the conference room, and he put up on the board a chart of the SPY stock that day. And the SPYs were rallying mid-afternoon, and he pointed out to everyone around 2 o'clock the chart made a certain pattern, and he said, any good professional trader at this point is going to go long SPY. Well, from 2 o'clock on, the market sold off that day. And even though he said at this point most professional traders would have gone long, the market sold off immediately after that. He then made the following point, which I always have found fascinating. He said, your job at that point was to go long. Even though the market sold off after that, you eventually would have been stopped out of the trade. Your job at that moment at 2 p.m. was to go long. In other words, Mike said, your job was to lose money at that point. Now, proprietary trading firms are not in business to lose money, so why would Mike have made a comment like that? And the answer is because in the long run, if you go long at that point, in the long run, in the totality of all of your trades, if you go long at that point, you are going to make money. You may lose money on any one individual trade, but in the long run, given that chart pattern, your going long would have resulted in you're making a profit over a large enough sample size of trades. So there are cases where you will lose money by following a very sound process. Now, how does this whole concept translate into market neutral options traders? Well, I was on a panel recently, last week, with some very successful options traders, and each of us were talking about our philosophies and what we learned from 2017 to help us to grow as traders. And one of our panelists was a guy named Ryan Moffat, who runs a company called Black Peer Capital. And Ryan made a really great point. He said, you can't reach the conclusion that a trade is broken because it has lost money. There is a trade, let's say a strategy that has been proven to be successful over a long period of time. Having said that, any particular trade that you're trading over a long period of time will go into periods where it's losing money. So an amateur trader would look at that situation, and after a couple months of the otherwise successful trade losing money, he or she might say, this trade's broken. And Ryan's point was, a trade's not broken if it's doing what it's supposed to do in the market that it is in. I'll repeat that. A trade is not broken if it's doing what it's supposed to do in market conditions which are not favorable to that particular strategy. So let me give you an example. Let's take a case in point. This is a chart of the last 5 years hypothetical returns of the bearish butterfly. This is where if you traded the bearish butterfly exactly according to the book, you followed every single rule in our series, you would have just barely eked out a profit in 2013. 2014, you would have had over 100% return. Same for 2015. 2016, you would have lost 46%. And in 2017, you would have made almost 150% return on the strategy. Bearish butterfly, and by the way, the average return over that 5-year period was 70.46%. So I don't know very many people who wouldn't want to trade a strategy that has that kind of return. But there could be, and there actually were, traders who started trading the bearish butterfly in 2016, lost 46%, gave up on the trade, and therefore gave up on the 143% return that they would have made in 2017 had they stuck with the trade. So what happened there? What happened there was that the traders who gave up on the strategy forgot that because the trade lost money in one particular market environment where it's supposed to lose money, he made the conclusion that it will always lose money, and that's just simply not the case with the bearish butterfly, as you can see from these results. Putting it another way, take a look at this chart of the Russell 2000 index where we trade the bearish butterfly for the year 2016, and you'll see that this is the kind of year where this trade's supposed to lose money. There was a big run-up in February, a big run-up off of Brexit in the summer, and a gigundo run-up right after the election of President Trump. And so those are going to be very difficult conditions for a bearish butterfly to be successful in 2016. So that's a year it's supposed to lose money. On the other hand, let's take a look at 2015, where it had over 100% positive return. This year, it's supposed to make money. Take a look at this chart. There were many, many periods where the market sold off in a manner that's conducive to profit on a bearish butterfly. And so it's not necessarily a bearish year where the bearish butterfly makes money, but it's a year where certain kind of bullish moves don't happen at certain times, and 2015 was one of those years. And so in 2015, the bearish butterfly is supposed to make money. So if the bearish butterfly had not made money in 2015, then you could start to build a case that the trade's broken. But to say in a year where no one sensible would believe a bearish butterfly could make money, that it should make money, then that is just not an intelligent way to look at it. So what are the implications of all this? There's a difference between a trade that stopped working and a trade that's not making money in periods of time when it's supposed to not make money. Abandoning a viable strategy right after it has had predictable losses, which anyone would have known would have produced losses in that particular market condition, abandoning the strategy at that time makes little to no sense. The only time you want to abandon a long-term profitable strategy is when it stops behaving the way it's supposed to behave, and that does happen sometimes. Market conditions change, options volatility conditions change, execution issues change. There's a variety of things that can happen that can cause a trade to stop working. But to fool yourself into thinking that a strategy has stopped working because it's lost once or twice in a row, then you're ignoring all the data that you had before you decided to enter into the trade strategy in the first place. So don't make the confused concept that a strategy that has lost money has stopped working when it's acted exactly as it should. Under those circumstances, you should stick with the trade and ride it through those periods where you will regain your losses and ultimately start to profit. Had you done that with the bearish butterfly over that 5-year period, you would have been a very happy person, even though in 2013 and 2016, you would have either broken even or lost money. But the gains in those other years are so terrific that the overall return, is outstanding over that 5-year period. But you had to stick with it. Yes, ask yourself all the way along, is this strategy working the way it's supposed to work? If the answer is yes, regardless of whether that yes is a result of a losing month or a winning month, if the answer is yes, and it's a proven strategy and you've back tested it and others have successfully traded over a long period of time, then you can feel pretty confident that you've just run into one of those periods where the conditions were simply not right for a profit on the otherwise valid and solid strategy. So don't fall into that trap of losing faith in a strategy which is behaving exactly as you expected it to. That way you can become a better trader long term by avoiding this kind of pitfalls in your thinking. Thanks very much, and we'll see you next week.